So FRS 102, Financial Reporting Standard 102, is the main UK accounting standard aimed for companies. For larger companies, they would use IFRS, International Financial Reporting Standards, and for the smaller companies at the end of the scale, they use FRS 105, aimed at micro-sized entities. The two key changes that this revision to FRS 102 is bringing is changes to the way leases are accounted for and some changes to the approach to revenue recognition. One particular thing to watch out for is the approach to transition under these two key changes to FRS 102. For leases, there is no change to the comparatives. But for revenue recognition, you do have to restate your comparatives, although there are some choices as to how you go about this. In terms of revenue recognition, this was previously under a risk and rewards based approach. The FRS 102 revised brings in a new 5-step performance obligation model. In terms of the impact of this change to revenue recognition, it should not impact on how much revenue in total is recognised, but it could impact on the timing of that revenue across different accounting periods. In terms of accounting for leases, previously there was a distinction between operating leases and finance leases. Operating leases were where there was just an expense going through the profit and loss account. For finance leases, this treated them as if they were owned and brought the asset onto the balance sheet. Under FRS 102 revised, all leases are now shown on the balance sheet as a right of use asset with a corresponding lease liability. There are some minor exceptions to this for low value items and for short-term leases, that is those less than 12 months. In terms of the impact that this change to accounting for leases will have, in the profit and loss account, the previous expense that either went through cost of sales or admin expenses now will be replaced by a depreciation charge as well as an interest charge. That will have a resulting impact on EBITDA if that is important to you in your company. On the balance sheet, there is now debt showing, being the lease liability, so this could impact on your gearing and in particular on any bank or loan covenants that you may have. These revisions to FRS 102 bring it more in line with IFRS, albeit a few years behind. Whilst it's not exactly the same as IFRS, the concepts are broadly similar. The whole intention of bringing FRS 102 in line with IFRS is to enable consistency and comparability, particularly when looking at companies that are using different versions of GAAP. FRS 102 is revised by the Financial Reporting Council on a periodic basis. It used to be every 3 years, but they moved away from that approach during the pandemic. These changes to FRS 102 take account for 31 December 2026 year ends and beyond.